Welcome to this evening's webinar, Discovering the Power of Dividends, Knowing is Half the Battle, led by Derek Hageman of AAII. A handout of the presentation is available under the handout panel on your GoToWebinar control panel, located on the right side of the screen, as well as instructions on how to operate the control panel on your device. If you have questions for our speakers, please submit them using the questions panel of your GoToWebinar control panel. Our moderator will select questions submitted and read them aloud for the benefit of all watching the broadcast. If you experience any issues with the audio or video of the webinar, please consult the instructions on how to change your device settings or consult the GoToWebinar for support, www.gotowebinar.com. A replay of the presentation will be available tomorrow on AAII's YouTube channel, along with this evening's handouts and some of the resources discussed. These links will be sent to your email address. Now, sit back, relax, and enjoy the live presentation. Take it away, Charles and Derek.
Good evening, everybody. Thank you for joining us. As many of you know, AAII is a nonprofit organization focused on helping individual investors, such as yourself, become better managers of their own assets through education, information, and programs such as this weekly webinar. Tonight, I'm joined by Derek Hageman, our editor of the AAII Dividend Investing portfolio. Good evening, Derek.
Hey, thanks, Charles. It's great to be here. It's a topic I love to talk about, so I'm excited to share some thoughts on how to analyze a company using the AAII system, and just really to talk about the power of dividends. So glad to be here.
Great to have you. And Derek, I understand this is a work anniversary week for you.
It is, actually. Thanks for bringing that up. It's not an anniversary for a gold watch or anything. It is actually my 1-year anniversary this week at AAII. So it's been a great first year. Time flies.
Well, I didn't want to tell you, but we typically give away gold watches for the 1-year anniversary, but you have to be in the office to get it. So sorry about that.
Well, that might be a while still then.
But speaking of the office, I know people don't realize this, but in your office, you do have a lot of musicians on your bulletin board. And being from Minnesota, I understand there's a couple famous musicians from your home state.
Yeah, definitely. It's from being from Minnesota, two things you absolutely know are the two most famous musicians from the state. That's definitely Prince and Bob Dylan. So like most Minnesotans, I'm a big fan of their music.
Both really great artists. And Derek, I know you like to go running in the morning. A little tidbit about Derek and I before we start. Derek and I did a small stair climb in February. How many floors was that, Derek? Do you remember?
It was way too many, but I think it was definitely over 100 floors. I've done a lot of interesting sporting events in my life. I actually played college baseball. And I'm into triathlons. I've done an Ironman triathlon, which I think I paid the honor to do that, and it took me over 13 hours. But the stair climb, that was something unique. And it's a lot of skyscrapers in Chicago. We did the John Hancock Tower, and Charles came to me one day in the office and he said, "Hey, how would you like to spend a Saturday climbing up over 100 flights of stairs?" And I guess I said yes to him.
Well, I thought I could use some more support after doing it so many times, but it was great doing it with you, and hopefully we'll get a chance to do it again. But I know today people are here to learn about dividends and not stair climbing. So Derek, I'll let you take it away.
Great. All right, I'll get started. Let me pull up the presentation here. All right. Well, again, welcome everyone. Thanks for joining tonight's presentation on the power of dividends. Knowing is half the battle. Yes, that is a reference to those out there that know G.I. Joe. So again, dividend investing, it really is knowing the process, knowing how to analyze what some of the key metrics are to look at. And that's what we're going to be talking about this evening. So I always like to just start off with some of the learning objectives. We're gonna cover how to analyze dividend stocks. We're gonna look at the 3 pillars of dividend investing. It's really the framework that we use at AAII, and we look at valuation metrics, growth trends, and financial strength. And we're gonna be going through examples of a few of those from each of the pillars. And then we're gonna touch briefly on some sell considerations. You know, oftentimes people talk about what to look for when you're gonna buy and add to a portfolio. They don't always address some of the selling considerations. So we'll touch on that briefly as well. Now you might be looking at this screen and wonder what this has to do with dividends. I mean, UPS is a dividend paying stock. I always like to just frame the presentation and give a little context and answer the question why dividends matter to me. And you see there's a little smiley face there, and that's really every time I see a brown UPS truck, I get a smile on my face. And really there's a couple reasons for that. My father worked at UPS for 25 years. He started as a driver, worked his way up the company, ended up as a regional manager for UPS. And he told me the story that his first dividend payment was $25, and he said he was absolutely thrilled with that amount. And you know, the longer he was with the company, he experienced. He was there at a time when UPS went public in 1999, and throughout his career, the dividend payments grew more substantial. And you know, there's a couple options you have with dividends. You know, one option is you can reinvest the dividend and really to experience the magic of compounding. You can buy more shares, so the original dividend will generate additional dividend income. And there's a great example. I can make sure that's a part of the show notes. It's an example from Coca-Cola. And we have to go back almost 100 years, but this is something that the company actually publishes on their website, and it really does show the magic of compounding. If someone had invested about 1 share at $40 in 1919, so yes, definitely a long time ago, and they never sold that share, they never bought more shares, they just let that share, the income they received from that, they just reinvested it back in. Well, that original 1 share at $40 investment, at the end of 2018, that's the last time Coca-Cola updated this table, that 1 share would be worth over $15.4 million. So it's kind of an extreme example, but it really does talk about the magic of compounding. The other thing you can do with dividends is you can use those to fund, use those as income. And that's why every time I see a UPS truck, I get a smile on my face, because we actually use that dividend income for summer vacations. And my parents continue to enjoy the benefits of the UPS dividends to this day. So I just like to share a little context of why dividends matter to me. So just briefly, what are dividends? You know, I've heard people say that dividends come from cash and they come from earnings. Well, actually, both of those are correct. They're paid from cash and they come from earnings. And really, just the definition here is dividends are a distribution of cash from a company to its shareholders. And I added this quote at the bottom of the slide. It's from John D. Rockefeller. And he says, "Do you know the only thing that gives me pleasure? It's seeing my dividends coming in." Now, this was the richest person in the world at one point, and he loved dividends as well. Now here, there's a lot going on this slide, and each one of these could likely be a topic in and of itself, but I'll just cover a couple of these. The benefits of dividend investing. One, it's passive income. You know, dividends provide a steady flow of passive income, which you can choose to spend, like my family did on summer vacations, or reinvest, like the Coca-Cola example. Inflation protection, that's one of the benefits of dividend investing. Unlike most bonds that pay fixed income, many companies increase their dividend payment each year, at least the type of companies that we look for at AAII's Dividend Investing. And 5, it's typically less volatile than other stocks. Now, dividend payers, they tend to be large, financially strong companies with more mature businesses. And dividend paying stocks can also provide a cushion against market risk. Now, when you think about dividend strategies, there's really 2 main approaches. And if you think of dividend strategies along a spectrum, on one side you have dividend income, and on the other you have high dividend yield. Now, tonight's focus is going to be on dividend growth. And for dividend growth stocks, they're usually better quality, less risk, lower absolute yield when compared to the high yield approach. Now, the high yield approach, it's a perfectly good strategy. A lot of people use it. They do seek higher yielding stocks. They can be lower quality and a little more risk. But in general, dividend strategies, they add to total return over time. Just one other thing on the dividend growth. So we focus on dividend growth, and we're looking for years of consecutive growth, and we're looking for consecutive increases as well. Now here is, I'd like to include this just because it really does speak to tonight's topic, the power of dividends. And dividend growth, it may be a key to outperformance. This is a chart that was put together by Ned Davis Research and Hartford Funds. And again, we can provide a link to this in the show notes. But it looks at dividend growers and initiators. It looks at the different dividend policies that companies have. So there's general dividend payers, there's no change in dividend policy, there's dividend non-payers, there's dividend cutters and eliminators. What we focus on is the top one, dividend growers and initiators. And they've historically provided a greater total return, and the volatility relative to other companies, it's been lower. And so you can see that on average, they've provided returns, average annual returns of 12.8% over time. So I like to point to that. I mean, that's really why we're talking about dividend growth stocks, because they can be a key to outperformance. Before we get started with the pillars, it's always important to ask yourself, what does a company do before you start to analyze it? And there's a few ways that you can get up to speed on a company. You can download and read the most recent 10K. I'm sure for a lot of people out there, that might be a good way to cure insomnia. But there's a lot of great information in the 10Ks, a lot of great information in the 10Qs. You can find that typically on a company's website. They have a financial information section where they have all their SEC filings. You can find it there easily. Another good thing to do is to read the last few conference call transcripts or listen to the last few conference call transcripts. And again, companies typically have that on their website. Some of the other resources that you can use to find transcripts, I think Zacks has a service. Seeking Alpha is a great resource for transcripts. They usually have the recording of the most recent earnings call up on their site, oftentimes the same day, but definitely within 24 hours. And one thing I pay attention to when I'm listening to those calls to get smarter on the company, I listen to the questions that analysts ask. So oftentimes there's sell side analysts that are on the call, and after management has gone through their scripted part of the conference call, they open it up to Q&A for analysts. And so the analysts just get to ask questions based on what trends they're seeing, what opportunities, what threats. They ask specific questions about financials. It's really a quick way to get up to speed on a company. It's also important to understand what a company's business segment is. For example, Walmart, they just reported this week, one of their largest segments, the groceries. I think it's over 50% of their revenues. General merchandise is another 37%, and then there's an other category. And so, you know, if you listen to the Walmart call this week, one thing that would stand out to you is their e-commerce sales. I think they were up over 75%. So these calls, they help you understand what's driving revenue, what's driving earnings over the last quarter, and what to look for in the upcoming quarters as well. So yeah, which segments are growing, which ones are slowing, and you also want to understand the geographic concentration. Where are these companies producing most of their revenue and earnings? You know, it also helps to understand who these companies compete with and who some of the customers and suppliers are. So the 3 pillars of dividend investing. So there's no particular order here, but the first pillar, we have valuation. And the second pillar is growth trends. And the third pillar is financial strength and quality. Now we might skip through this slide, but we are gonna get into each one of these pillars further down in the presentation. So let's get started with the valuation and attractiveness. So stock prices, they tend to fluctuate between high and low extreme valuation levels. And these relationships can be used to determine a stock's value. And the characteristics that we analyze is dividend yield. We look at trailing PE ratio and forward PE ratio. But the main valuation metric that we use at AAII's Dividend Investing, it's the dividend yield. So if you print out your presentation, or if you just make a mental reminder, I would definitely put a few stars on this one. I often refer back to this one just to keep the relationship between stock prices and yields, the relationship. But let's just start with what dividend yield is. We have the equation there. It's the annual indicated dividend per share divided by the stock price per share. And the dividend yield, it indicates what an investor pays for a given level of dividends. And you see in the middle section here that stock price and dividend yield, they're inversely related. So if the stock price goes up, yield goes down, and vice versa. If stock price goes down, yield goes up. So just one way to get this concrete in your head is, for example, if a dividend was $1 and the stock price was $30, then the dividend yield would be 3.33%. If we hold the dividend steady, so the dividend in this example, if we held it steady at $1, but the stock price goes up $5 to $35 per share, then the yield goes down to 2.8% from the 3.33%. And again, if we hold the dividend at $1 and the stock price goes down to $25 per share, the yield would go up to 4%. So that's just, it just shows the relationship that between stock price and dividend yield. And again, the relationship is important because it allows an investor to understand how this measure is being affected over time. It's good to track this over time. And in this bottom, to help determine a stock's valuation, we compare its current dividend yield to its historical average yield, and we also compare it to its market yield. So a buy signal for us, typically meaning it's undervalued, and this is again relative to its historical yield, it's when the current yield is greater than its 5-year average yield. That is a sign to us that the stock may be undervalued based on its historical average. And again, the sell signal, that's the signal that a stock could be overvalued, that's typically when the current dividend yield is less than its 5-year average yield, low yield. So again, there's a lot going on in this slide. I refer back to it all the time, but it really is helpful. This next slide, and this is a concept from Geraldine Weiss's book called Dividends Don't Lie. It actually goes back to the late 80s, but a lot of these concepts come from this book among other studies. And what we see here is across the top we have annual indicated dividends, and we assume that the stock's dividend goes up 2 times over this period. You can see it from $2 to $2.50, from $2.50 to $3, and you can see that it forms some peaks and troughs over time. And of course, stock prices don't move so perfectly, but it illustrates how yield works over time. So if you took in this example, there's 6 peaks: the 2.5%, the 2%, the 2.1%, and you divide those by the period. So there's six periods in this example. The average is 2.2%. That's the average of the overvalued yield. So if a current yield on a stock was 1.9%, that would be a sell signal for us. And we have the same thing for the troughs here. We have the different yields over time divided by the number of periods, and we come out with 4.2%. And that, in this case, the average is an undervalued yield. So if the current dividend yield was 5%, it's above the 4.2%, that would be a buy signal for us. And here again, I just want to, and tonight we're going to be going through using Hubbell Incorporated. It's a global electrical equipment company. We're gonna use that as we go through these different metrics, looking at the valuation, looking at the growth trends, and looking at financial strength. And Hubbell, its ticker symbol is HUBB. It's actually one of the most recent stocks that we added to the dividend investing portfolio. And the dividend investing portfolio, it's a real money portfolio. It includes 24 hand-picked stocks, and this is one of the most recent additions. And so we're going to use that as we go through here. And really, our investment in Hubbell, it was a investment based on industrial infrastructure spending, particularly from improvements made to the U.S. power grid. And some of the growth drivers for Hubbell were the transition to renewables and the technology adoption like smart meters. So we're just going to use that as an example. Again, we're not using this as a buy or sell recommendation. Just this is what the dividend investing portfolio most recently invested in. So at the top, we have dividend growth and stock price change in yield over time. We have a couple more relationships. So typically when the dividend growth is greater than stock price growth, that's when yield increases. When stock price growth is greater than dividend growth, that usually drives the yield down. So we just have an example here for Hubbell. The current yield is 3.2%. And you can see that our typical buy signal is when the current yield is greater than the average yield. And in this case, it's actually greater than the average yield and the high yield. So it was definitely undervalued based on its historical dividend, 5-year dividend yield average. And in this graph here, this chart here, we just show the dividend growth from 2012 through 2019. And you can see how that's trended through time. You can also see the stock price. And I just want you to focus on the far right of that timeline. And you can see why the actual current yield is higher than the 5-year average now, because the dividend growth of 6.1% is growing faster than the stock price growth. And in this case, it was negative. It was negative 23.3% from 2018 to 2019. So that created an opportunity for the dividend investing portfolio. And I'm sure there's probably we've probably received a few questions on this. So Charles, I don't know if there's any questions have come across on this that I could answer. I'd be happy to do that now.
Absolutely. We've gotten quite a few questions regarding your slides.
Okay, great.
Yeah, I'm going to go through these. One of the questions we're getting actually has to do with, we're getting a lot of questions about evaluating dividend cutters. How do people find them? How do people identify them? And I know you've written about this, and you'll have an article about cash levels in the June Journal, but could you elaborate a little bit about some signs people can look out for?
Yeah, definitely. It's a great question, especially given the environment we're in. I think every day I see a company that's cut their dividend or suspended their dividend. Especially there's been certain sectors that have definitely been vulnerable. The energy sector has just had a slew of companies that have cut their dividend. I think Schlumberger just had announced a dividend cut today. There's lots of companies in the restaurant space that have cut their dividend, several retailers. And to answer your question specifically, Charles, so that what we focus on for dividend cutters, the red flags, they really come up in the third pillar, financial strength. When we start looking at the payout ratios and the free cash flow payout ratios. So we will definitely talk about that later in the presentation. I promise your question will be answered, and we'll give some guidelines of what to look for. And you know, you never know. I mean, there's been some companies that actually announced a dividend increase, and 3 weeks later, things were changing so quickly with the coronavirus pandemic shutting down the economy that some of these companies, after increasing their dividend and actually announcing a share buyback plan, 3 weeks later they were, I mean, their complete business, their business model changed overnight, and they actually cut. So again, there's no definitive way to do this, but there are some metrics that we can certainly look for. And another just point on that is, one thing we look for is just consecutive years of payment. Now, for the dividend investing portfolio, we look for companies that have increased their dividend for 7 years consecutively. There is another group of dividend-paying stocks, probably a lot of people are familiar, called the dividend aristocrats. Now, these are a lot of household names that people are familiar with: the Walmarts, the AT&Ts, Coca-Cola. And these are stocks that have increased their dividend consecutively for 25 years. So these are, you know, so that's another metric that we look for besides the payout ratio, is just, you know, have they consecutively grown their dividend? How many years? Because one thing that's important to remember is once a company starts paying a dividend, they're very reluctant to cut it because they know that their stock price will typically get crushed if they do that. So once they start paying a dividend, they are more apt to want to continue paying that. And just for everyone out there joining tonight, I just want to add one thing about Charles's background. So you're very fortunate. Charles was actually one of the co-creators of the dividend investing portfolio. So he's, you know, not only is he the editor for the AAII journal, but he has a wealth of knowledge on dividends as well. So, you know, Charles, feel free to add something if I've missed as well.
Well, I think we successfully passed the torch to you, but had a lot of help internally. John Bekowski played a big role in DI as well, and Wayne Thorpe certainly helped out. We are getting a few questions about the relationship between the price of the stock and more specifically, the price fluctuation of the stock and what that means to the dividend. Could you comment on, if people see the price dropping, should they be concerned about the dividends, or is there certain factors they should pay attention to other than the price to kind of gauge dividend safety? I know you addressed some of those things a second ago.
Yeah, I mean, really for us, it's you want to compare it over a long period of time. We look at the 5-year range, and every year at the end of the year, those dividend yield metrics will shift, will move the calculation forward. But really, you want to pay attention to where the current yield is in relation to the high, the 5-year average high, the 5-year average, and the 5-year average low. It's the movement in the stock price is reflected in the current yield. If we just go back and look at this first where it says dividend yield, if you look at the formula, it is the annual indicated dividend per share divided by the stock price per share.
Great. And Terry, as long as you're going back through slides, we got a question. You showed a slide earlier with a formula. I believe it was A equals L plus OE.
Yeah.
One of our attendees was actually asking about that formula.
Great. Yeah, sorry, I have some acronyms there, abbreviations. So yeah, that's the balance sheet, the accounting equation is what it's called, and the A stands for assets, the L stands for liabilities, and the OE stands for owner's equity. And in accounting, you always have to keep the assets in balance with the liabilities and the owner's equity. So what we're showing here is just when you pay out a cash dividend, cash goes down, so your assets go down, but at the same time, your owner's equity goes down. So that equation is always in balance. So hopefully that answers the question for people. Sorry about that.
No, that's fine. I'll ask you one more question and I'll let you get back to the presentation. But we are getting some people asking about where they can find data on the 5-year average dividend.
Yeah, now that is one thing we calculate in-house. So I know we calculated for every given company using our research database called AAII Stock Investor Pro. I'm not aware of any other sources. Maybe Charles, are you aware of any places where people can go? I know there's a lot of resources out there on dividend information. If you go to dividends.com, even Seeking Alpha has a lot of dividend related information, but I have not actually seen that calculation at any other site.
Yeah, it's not very common. Some sites will have historical data on the dividends, and then you could figure out the year-end price and do a rough average. It's not a number that is readily available, but as you said, in Stock Investor Pro, we actually have the 3, 5, and 7-year average dividend being calculated right there on a site. But if someone can just find historical dividend data, historical price data is easy to find as well, such as on Yahoo Finance. They could do a rough calculation so they actually can see and run a simple average on their calculator to determine what that number is. But I'm watching questions. Derek, I'll let you get back to the presentation, but I'm taking notes and I will pass along some of the questions again in a little bit.
Okay, great, thanks. I just wanted to continue, and again, the dividend yield evaluation metric, that is the primary metric, but we do also look at the price to earnings ratio, so the PE ratio, and we have the equation there. The PE ratio is the stock price divided by earnings per share, and the earnings per share, that can be trailing 12 months or that can be forward-looking earnings. And the PE ratio, it's important that you compare it to historical average. It's important you compare it to market average, and typically the higher the value, the higher the price for a given level of earnings. That's what a high PE ratio means. So value investors, and that's definitely what we are at Dividend Investing. We're value investors, so typically we're looking for a lower PE stocks, whereas growth investors, they're less concerned about PE. Let's see, and one of the reasons we prefer the dividend yield is because, if a company doesn't have earnings, or if earnings are negative, the PE ratio is meaningless. So that's one of the reasons we prefer the dividend yield valuation. So again, using Hubbell as our example, we have the average price here. We have the average earnings per share, and that's on a diluted basis. Now these are numbers that you can find on Yahoo Finance. A lot of financial sites provide these types of numbers. And for Hubbell specifically, we look at the average PE throughout time on the timeline. And you can see that in 2017 it was 22.9 times, and it has drifted down over time. It's currently at 15.4 times. Now, what gives meaning to this number is when we compare it to its 5-year average PE. And down below you can see that the 5-year average PE for Hubbell is 19.7 times. And so you can see that it's lower than its historic average. So again, it talks to perhaps it's undervalued based on its historical average. We also like to compare the PE ratio to the industry that the specific company is in. So we have here that the 5-year average PE for the industry, we have that as well. So that's one of the other metrics we use. We want to see how it compares to itself. We want to see how it compares to the industry. And in both cases, Hubbell's PE is lower than the 5-year average. And one thing, let me just go back to this. Now you don't see it here as much because Hubbell's earnings have been positive. But for example, if we were analyzing a cyclical company like a Caterpillar, what you would see if you looked back over time is that, hey, it's a cyclical company. It rises and falls with the general economy. So some years it's going to do really well and have positive earnings. Other years when we're in a downturn, earnings can be negative. So you can see that from one year you'll have a positive PE. The next, it will be not meaningful. And then the following year, perhaps when earnings pick up, all of a sudden you'll have a number that might be above 100. So it's not really super useful as well. So again, that's one of the reasons we prefer the dividend yield. It's more stable typically versus the PE valuation metric. So those are some of the main points and metrics that we wanted to cover in terms of dividend valuation. Next, I want to talk about the second pillar, which is growth trends. And so we have here, a company's success is driven by its ability to generate sales and convert those sales into earnings and cash flow. So some of the characteristics that we analyze for the growth trends pillar, we look at revenue trends, we look at margin trends, we definitely look at earnings, we look at the dividend history, we're looking for consistency. Again, I mentioned that the dividend investing portfolio, we look for companies that have consistently paid dividends for a long period of time and have consistently grown those dividends. And really the question we ask for this pillar is, does and can the company grow its dividend? So those are the characteristics that you want to look at for growth trends. And you don't want to look at one of these pillars just on its own. It's very useful to look at these all together. So that's another important thing to keep in mind. So let's just dig into the growth trends a little more. So profitability. So the key metrics are, we look at margin growth and we look at earnings growth. And we're trying to answer the question, does the company make money? They have to make money to pay a dividend and make sure it's sustainable. So we're analyzing historical trends of company, and we're analyzing corporate and industry profitability as well. So under margin growth, again, we're looking at gross margins, operating margins, and profit margins, and we'll have an example of these coming up, and I'll get into some of the definitions of those terms. In general, higher margins are better, and again, it's very industry specific. And I usually get questions about what are typical ratios for industries. I don't have that slide now, but that's why it's definitely important to compare to industry averages. Expanding margins, they're a signal of competitive advantage. And for earnings growth, we're looking at historic, expected, we're looking for earnings surprises. And right there, that second point under earnings growth, dividends can't grow without earnings. So we look at historical and expected earnings growth as well. So here is an example using Hubbell. 1 second. All right, so here again we have a timeline of Hubbell, and it's when you're analyzing companies, it's just good to look at how have margins trended over time. Are they improving? Are they worsening? And here, if we look at the operating margin, I mean, back in 2015 it was 14.6%, and why did it go? Why has it gone down over the last couple of years? Well, there is one main reason for that, and they have seen slowing demand and price erosion in their legacy lighting business, and it was really due to the rapid adoption of LED technology. So that's why when I talked earlier, it's important to understand a company's different segments. Had people looked at that segment, and you would see how much a percentage of revenues, how much a percentage of earnings, and you could have asked yourself, hey, if something happens and there's new technology, what could be the impact to the company's margins? The other thing I want to point out, at least on the operating margin, and operating margin, I have the definition under the table. It's the operating income divided by sales. We like to look at the 5-year average as well. And even though the current operating margin is below the 5-year average, we do see it starting to pick up now. And they made a large acquisition in 2018, which I'll talk about in a second, that they hope will improve those margins. So we feel confident that they will increase margins over time. On the second row, we have the operating margin for the industry. And you can see, even though Hubbell's margin has been declining and is now starting to see an increase, you can see that compared to the industry that it's in, their margins are 6.1%. So compared to the industry, Hubbell's margins are quite strong. The net profit margin, that is net income divided by sales. You can see the trend there over time. And two other things we look for in terms of growth trends. We look for earnings per share growth year over year. You can see a little fluctuation here, but on average, the compound annual growth rate over the 5-year average compound annual growth rate for Hubbell is 5.9%. And we also look at dividend growth year over year. You can see the trend there. And that compound annual growth average has been 10.9%. And again, expanding margins signal competitive advantage. All right, here we wanted to look at growth trends. We talked about consistency and growth, how important those are. And again, those are some of the things you look for. You asked the question, Charles, or you relayed the question from a lot of members that joined the webinar tonight. What are some of the signals you can look for? You know, this is a good place to look. How long has a company been paying their dividend for? I put a few examples in here. A Walgreens, they've been paying a dividend for 44 years. PepsiCo has been paying for over 48 years. Medtronic, 42 years. And actually, if we're talking about Hubbell, they've paid a dividend since 1934. So they have a long history, and that gives us some confidence that the dividend, even given these tough times, that it could be safe. So when we're looking at dividend consistency, again, we're looking at a record of paying and increasing dividends. We also want to know, has the company ever cut its dividend, and why? One thing, and I should have mentioned this earlier, but one thing we've definitely been focused on as we've been looking at our portfolio, and we've had some new additions, some deletions, we've looked back to 2008 just as an example of what happened in the last time there was a financial crisis. Did these continue to pay their dividend? Did they increase during that time, or did they cut? So that's another thing that people can look for dividend cutters. What did they do during the last turbulent time in the economy? Long-time dividend payers, they've done well over time. And the bottom line is consistency shows commitment. It doesn't guarantee it, but again, I mentioned that once companies institute a dividend policy, they are very hesitant to cut it. They will typically, it'll be one of the last things they do to conserve cash. They will typically reduce share purchases. They'll look and see if they can reduce capital expenditures. They can see if they can take some expenses out of the company. So they'll look at operating expenses. And if cash is still a problem, then that's when they may look at the dividend. Dividend growth, we look at historical dividend growth patterns. Again, the types of companies that we prefer companies that have a dividend growth above inflation. And another thing to keep in mind is dividend growth, it can't outpace earnings growth over the long term. And I just included an example of United Health Group, another great dividend paying company. You can see how they've grown their dividend over the years. And Charles, just want to make sure we're getting folks' questions answered. Has there been any questions that have come across in terms of growth trends and dividend consistency?
So there have been actually. One of the things that people ask, someone asked, how do you differentiate between growth and value? How do you make that decision between it's a growth stock, it's a value stock?
Yeah, I mean, a lot of times you can look at the fact that a lot of growth companies don't pay dividends. For example, Amazon, they feel like they can do more things with their money by reinvesting in the company, acquiring other companies instead of paying a dividend. So that's one thing you can look at. Typically, growth companies, they don't even have a dividend policy. For example, Apple, for the longest time, they were your typical definition of a growth company. They were reinvesting, acquiring companies, and they were reinvesting back in their business. And they got to a point where it was tough to find that growth, and they actually instituted a dividend policy. Another thing you can look at is what I touched on earlier. A lot of times you can see just by looking at the PE ratio. Value stocks typically have those lower price to earnings ratios, where growth companies they trade at a higher PE. So investors are willing to pay a higher price for that growth.
And speaking of growth, another person referenced the chart you showed earlier about Hubbell, and the question was, at what point does slowing dividend growth become an issue? He pointed out that Hubbell's dividend growth has slowed quite a bit over the years. So how do you make the decision between it's still good, or if it's slowing too much?
Yeah, no, it's a great question. I'm glad you asked that. So we do look at a few different metrics. The one here is we do look at the 5-year average. We want to see where it is in comparison to that average. And probably the more important thing, a couple things. So you want to look at, excuse me, just lost my train of thought there for a second, but you want to make sure that it's growing faster than inflation. That's pretty much the first criteria. And that's one of the differences between the dividend aristocrats. They're great companies, have shown great consistency in increasing their dividends, but a lot of them now are at the point where they're only increasing their dividend by a penny. So, you want to look at historical trends as well, and you want to look at what other opportunities are out there. How fast are there how fast are other companies increasing their dividend? So there's a couple metrics that we look at. And I don't know, Charles, if you have a few other things that you could add on to that.
Yeah, I was going to point out, so we originally held AT&T in the portfolio for several years, and we ended up getting rid of it. And one of the problems with AT&T is every year it would raise its dividend by 1 penny per quarter, so 4 cents a year. Because the absolute amount of the dividend, the absolute increase was increasing at the same amount each year, meaning 4 cents per year, we saw the actual rate of growth slower and slower and slower. And we really saw the dividend came down. So technically, it was continuously growing its dividend, but you start realizing your rate of increase became slower relative to the rate of inflation. So you do want to see that consistent growth, but you also want to stop and look at it, at what does it actually mean on a percentage basis. And so if a company's raising its dividend by the same amount every year, those percentage increases might become smaller and smaller and smaller. Now, granted, it might be dropping from 20% down to 10%, which is still great growth, but it's falling from 5% down to, say, 1%, then that changes the math, and it should change your perception about how strong that dividend growth is, because if the dividend growth is too slow, then you have to count on the stock price to protect your portfolio against inflation. But Derek, I wanted to ask you a couple other questions. A few people have asked about buying dividend stocks. One attendee asked, after looking at the DI portfolio, and they want to put new funds into investing into dividend stocks, how do they decide which stocks to look at first as potential candidates? And another attendee asked, how many dividend stocks should they actually own in their portfolio, assuming they want a portfolio that is diversified at the security selection level?
Great questions, and thanks for adding the point about the dividend growth, what we look for. To answer the first question, so yeah, there definitely are specific rules that we look for, and we have so when we analyze a company, there's over 40 different screening characteristics that we use. And we try to follow a rules-based methodology. We're trying to take our own biases out of the mix. So we have certain criteria. And so if you're adding a stock from the dividend investing portfolio, the first criteria is, does that company still pass our initial screen? So is it growing so just to give you a few of the metrics that we look for. Has it increased its dividend for 7 consecutive years? Is the dividend growth rate greater than 3%? Is our sales growing at 3%, the 5-year average sales growth rate? So that's the first thing, is we look for companies that are still currently passing the screen. That means they're meeting our valuation criteria, meeting our growth trend criteria, and meeting our financial strength characteristics. So they're meeting all 3 pillars of the dividend investing portfolio. Another thing you can look for is you can look at the yield on a stock. So if you want a higher yield, and you see there are certain companies that have those higher yields, you could invest based on the yield. You could look at valuation. That's one of my favorite metrics to look at. How is it overvalued or undervalued compared to its 5-year average? So looking at the valuation might give people an idea of is that a good one to add to the portfolio. Another thing that we look for is if a certain holding in the portfolio is under or over weighted. And we try to keep things at equal weight. So if a stock has become underweighted, we will try to increase that, assuming that the valuation metrics are met as well. So there's a few different characteristics we look for when adding to the portfolio. To the question on diversification, so again, the dividend investing portfolio, that includes 24 rising dividend paying companies. We feel that gives enough diversification. We have, if you look at those 24 stocks in our portfolio, we have stocks in technology, we have stocks in healthcare, we have industrials, we have cyclicals, we have non-cyclical stocks. So we really have a great array of sectors and industries covered. So we feel like 24 stocks does definitely give us diversification. Any other questions, Charles?
Yeah, I'll ask you one more, and then I'll let you get back to the presentation, so we're not keeping everybody up too late. But
Okay,
we are getting
thanks.
questions about the relationship between buybacks and dividends. Are buybacks considered? Should dividend investors put more focus on one or the other? I think the big questions people are asking is, looking at dividends and buybacks in terms of evaluating stocks, where should an investor have their preferences?
Yeah, great question. The shorter answer is we like both, but we prefer dividends just because of the sustainability. Again, I know I've mentioned this a couple times, that once a company institutes a dividend, they're hesitant to cut it or slow it down. But with a share buyback, now these are things that a company can announce that 1 year they're going to buy $5 billion worth of shares. The next year it's 3. It's not something that's expected always. If a company suspends its share repurchase program, typically a stock price doesn't get impacted as much as if the company had suspended dividends. And that's definitely something to look at, because a lot of companies have suspended dividends. So it's something we keep a focus on. When we listen to the earnings call, we're always curious if they are going to maintain their program of buying shares back, how much they have left from the board of directors, the policy on how much they have left to apply towards share buybacks. But again, we like both. They both generally have helped returns, but we prefer dividends just because of the consistency and the sustainability.
Great, thanks, Derek. I'll let you get back to the presentation, and I'll see you afterwards and ask you some more questions.
Okay, thanks.
Sure.
All right, so we've covered 2 of the 3 pillars. I want to talk about the financial strength, and really a lot of these characteristics analyzed will hopefully give folks some comfort in, will a stock be a dividend cutter? So some of the characteristics analyzed, we look at the earnings payout ratio. I'll cover that definition in a second in an example. We look at the free cash flow payout ratio. We look at leverage ratios. We also look at the interest coverage ratio, and we're looking at how much capital has the company returned in terms of share buybacks and the dividends. And we're really trying to understand the underlying financials and a company's ability to generate cash flow, pay its obligations, and return capital to shareholders. And can the company sustain its dividend payment in the future? That's what the financial strength dividend investing pillar is all about. So the dividend investing portfolio, and for dividend investors that are looking for that dividend growth and income, we're looking for companies, we're seeking sticky dividends. Can a company sustain its dividend? So financial strength, we're trying to understand the company's underlying financials, and again, its ability to generate cash flow, pay its obligations, and return capital to shareholders. And this really ties into dividend sustainability. Can the company support the dividend, not only in good times, but in bad times? And that's one of the reasons that when we're analyzing companies, and companies that are in our portfolio now, we go back to 2008 financial crisis and want to understand, what did they do during those bad times? And the dividend sustainability, the payout ratio, we're looking at earnings and free cash flow. Again, financial strength, high leverage is bad typically, not always, but generally. We're looking for long-term earnings growth, because dividends are derived from earnings. And we're looking to see if the companies have that long-term competitive advantage, because this is really what If you go back to the growth trends, what helps improve their margins over time, what then falls down to the bottom line and eventually ends up in earnings, which drive dividend growth. So again, we're seeking sticky dividends. So two of the metrics we look at the earnings payout ratio, which is the dividends per share divided by earnings per share. And we look for free cash flow payout ratio, which is dividends per share over free cash flow per share. And underneath there, we have the definition for the dividend investing portfolio of free cash flow. It's the cash from operations less capital expenditures. And this calculation is a pre-dividend calculation. So when you're looking at payout ratios, generally lower is better. And again, it depends on the industry, and we'll get to that in a second. You generally look for payout ratios that are lower because then it shows that there's room to grow that dividend. If the dividend is too high right now in this current environment, yeah, that would be perhaps a red flag that they might be one of the next dividend cutters. Definitely, if they have a high payout ratio greater than 100%, that's just not sustainable over the long term. So that would be another red flag to look out for. We know that this, from time to time, this could happen, but if this is consistent over time, that's definitely a red flag. Again, it's important to compare the payout ratio to the industry and historical average. And a lot of times companies, and this is one of those nuggets that you'll get from reading an earnings call transcript or listening to the conference call. A lot of times companies will let you know what their target payout ratio is. And I think we'll go to the next slide, just looking at again, Hubbell as an example. We have the timeline here. And there, if you look at the 2019 column, you can see that Hubbell's payout ratio is 45.8%. It's below their 5-year average payout ratio of 50.1%. So this gives us confidence that, hey, there's room to grow. They're not at their 5-year average. They can grow up to that average. So again, there's room to grow. We look at free cash flow per share. For Hubbell, in this example, you can see that cash flow per share has been rising. It was $4.40 in 2015, and in 2019, it's grown to $9.15 per share. And on average, it's $6.54. So again, you just want to look at trends over time, and this goes into our free cash flow payout ratio. You can see that that's actually, it's been a little up and down. It was 50.9% in 2015, and it's 36.7%. So even though free cash flow per share has gone up to $9.15 a share, they're only paying out 36.7% of their free cash flow as dividends. So this gives us confidence that Hubbell, in this current environment, they're at an appropriate level based on their 5-year average, and there's room to grow. And I always get asked this question, hey, what's the payout ratio for different sectors? Now, unfortunately, I didn't update this slide. It's a bit dated. The information in this is from November of 2019, but really it does provide a rough estimate of the different sectors, and it really does matter on the sector. So if you look at utilities, their median payout ratio over the last 12 months, going back to November 2019, for that sector was 62.2%. And we're comfortable if there's a utility dividend paying company, if their payout ratio is a little higher, just because utility companies, they have stable earnings, as opposed to a technology company. You wouldn't necessarily want a technology company paying over 60%. You can see that here the sector median average is 39%, just because technology companies and cyclical companies, their earnings tend to fluctuate a little bit more than a utility. So it's important when you're analyzing these companies to look at the sector medians. One other thing to look for in terms of financial strength is the interest coverage ratio. We have the definition here. It's earnings before interest and taxes, EBIT, divided by interest expense. And what this ratio shows us is how many times the company can cover its interest expense with its EBIT. You're looking for a higher number here. The higher number here, the better. For the dividend investing portfolio, we're typically looking for companies that have an interest coverage ratio greater than 2 as a minimum. The interest coverage ratio, it measures the company's ability to meet its debt obligations. Again, higher ratio is better. And let's just get into an example here, again with Hubbell. You'll see here that, I mean, they definitely have an interest coverage ratio where their EBIT is covering their interest expense. They were covering it in 2015 at 14.5 times. It has gone down, but it's still above that 2 times that we look for. So very, very strong, a lot of ability to cover interest payments and meet its debt obligations. One of the reasons that the interest coverage ratio has gone down, well, before that, it's also important to look at long-term debt to capital. You can see that metric has actually increased over time. And the reason for that is Hubbell has been a serial acquirer. So to grow their business, they've acquired a lot of different companies over time. They made their largest acquisition in their history in 2018. They paid $1.1 billion for a company that got them into the power meter space, which is one of the growth drivers for the industry. Power meters in terms of measuring water, electricity, etc. So even though the long-term debt to capital has increased, mainly due to acquisitions, the interest coverage definitely comfortable with the range that's in. So a couple of the metrics that you should look for if you're a dividend investor. And this just really summarizes the 3 pillars all in one. I show some of the screening characteristics.
Just a moment.
Oops. Sorry about that. Hopefully you can all hear me still. These are select dividend investing screening characteristics that we look for. We look for the current yield greater than the 5-year average. If you look at Hubbell, they have a 3.2%, which is greater than the 2.5%. At least 7 consecutive years of dividend increases. Hubbell's been 12 years. We look for a 5-year dividend growth rate. So this is the growth trends. We look that it's greater than 3%. We also look at a 5-year average sales growth rate, 3%. We look for a 5-year earnings per share rate above 3%. These are all metrics that you can use when you're analyzing companies. We also look for an operating margin over the last 12 months that's greater than the industry that the company operates in. And we look for an earnings payout ratio over the last 12 months that's less than or equal than 50%, because again, we're looking for a payout ratio that the company can grow its dividend safely. We're looking for a times interest earned over the last 12 months greater than, here I have 3 times, but actually I think that might be a typo. It is 2 times. And we look for a long-term debt to capital over the last quarter less than or equal to 50%. And you can see how, in this case, Hubbell has met all those screening characteristics. And just to finish up, I wanted to provide a framework for the sell consideration. We do look for excessively high yield. That can be a signal of a dividend cut. We look for yields that are below the benchmark yield. So we always want to compare a company's yield to the benchmark. The benchmark that we use is the IYY. It's the Dow Jones, and their current market yield is 2%. The dividend investing portfolio Last time I checked, the dividend yield was above 3%. So we always want to compare a company's current yield to the market and the company's historical average. Lack of dividend increase. We want to look for growth consistent. If growth is consistently less than inflation, that would definitely be a sell consideration. Interest coverage ratio below 2 times. We mentioned that. And we want to just look and see if there's better dividend growth opportunities available. So think when you're looking using this framework, have there been changes regarding the growth, consistency, or sustainability of the dividend? So just to wrap up, the key takeaways is I wanted to cover how to analyze dividend stocks. I wanted to talk about the benefits of dividends, passive income, higher growth potential, inflation protection, and less volatility than other stocks. We covered the 3 pillars of dividend investing. We looked at the valuation metrics because stock prices, they tend to fluctuate between high and low extreme valuation levels. And we can use these relationships to determine a stock's value range. We looked at another one of the 3 pillars of dividend investing, growth trends, because a company's success is driven by its ability to generate sales and convert those sales into earnings and cash flow. And financial strength, we want to understand the company's underlying financials and its ability to generate cash flow, pay its obligations, and return capital to shareholders. And lastly, we looked at a framework for sell considerations. If it has an excessively high yield, the yield is below the benchmark yield, there's been a lack of dividend increases, continuing poor fundamentals, they're all potential sell considerations. And I would be remiss if I didn't talk about the dividend investing model portfolio. So I am the financial analyst and editor for the dividend investing portfolio. It is a real model portfolio with real capital invested. It is a portfolio with 24 hand-picked dividend-paying growth stocks. Part of the dividend investing service, there is a monthly dividend investing newsletter that we cover in depth different companies that are part of the portfolio. We give updates on the general economy. We give updates on the top performing stocks in the portfolio, the stocks that aren't performing well. And then on the back page, because everything we do at AAII, it definitely has an educational focus. So we call it the back page article. And every one of those articles is dedicated to an educational topic related to dividend investing stocks. And we also have something on our website. It's called the DI Ideas. And these are companies that they may not be in the dividend investing portfolio, but they do all meet the characteristics. So if you don't like one of the holdings in the portfolio, if you prefer more investments in a different sector, people can look here for ideas as well. And typically the DI Ideas, it has anywhere from 25 stocks passing up to 50, just depends on where we are in the market. And with that, Charles, I can turn it back over to you.
Sure, absolutely. And I appreciate everybody for staying. Derek, I would say you're getting some great feedback from the attendees, and well-deserved at that. I do want to ask you a couple of questions. I got several questions throughout the presentation about dividend-paying ETFs, dividend-paying mutual funds, I believe even some closed-end funds. Do you have an opinion on those vehicles?
Yeah, I mean, there are a lot of great dividend-paying ETFs that have similar strategies based on looking for dividend growth and income. So there are similar ETFs out there. The one thing you don't get with some of those, you don't obviously get the educational component, but you do get the diversification. You do get stocks that typically, if you look at a lot of those dividend ETFs, typically you will see monthly income. That's one thing with the dividend investing portfolio. With the companies we have in our portfolio now, there's at least one company every single month that has is paying a dividend. I think you would see that with ETFs as well. And a couple of ETFs to look at. There is the Dividend Aristocrats. I've talked about that tonight. There's one that's managed by ProShares. Its ticker is NOBL. You know, it's a great ETF. The one thing I would say about that is that they really, the only criteria you need to qualify to be a Dividend Aristocrat, and it is a high bar. It's that a company has to consecutively pay dividends for 25 years and be a member of the S&P 500. It doesn't take yield into consideration. It doesn't take valuation into consideration. So it's just something to think about when you look at some of these other vehicles. And
Great.
again, Charles, I would love for you to add something to that as a you know, a dividend guru yourself.
Guru is a strong word. No, I think you answered it really well. You know, there's a lot of funds out available. One of the things I would encourage people to do is look specifically at that underlying portfolio. There was one ETF we saw when we were doing our ETF quarterly for this month's journal, and it had a name like Super Dividend or something, and it sounded like, well, it's a dividend-paying ETF. It sounds maybe like it's a little bit more conservative. And then you dug into the portfolio, and some of these are foreign companies, so I had to type in the company's name into Google and see exactly what they did. But it was a lot of energy, a lot of commodity companies. So just like you can't judge a book by its cover, you should never judge a fund, an ETF, or even a closed-end fund solely by name alone. Actually, take a look at the prospectus, take a look at the portfolio and see exactly what they're holding, what their strategy is, because it may not be the strategy you would expect it to be or the portfolio you would expect it to be just by the name itself. Derek, one of the questions we did get, however, was if you could comment on yield from the stock owner's perspective versus the buyer's perspective. I don't know if everyone's aware that the yield that an owner actually realizes might be different than what a buyer is going to get when they pay for the stock.
Yeah, I mean, simply I can just say it really depends on the price you paid for that particular stock. So is that, I mean,
yeah, absolutely. I think it's a big key just to add on that. So when you buy a stock, you lock in your yield because all future dividends are going to be based on that price you paid. Another buyer is going to be paying the market yield, the yield that's quoted. So your actual yield could be lower than the market yield. Finally, one last question. I know it's getting late, so I don't want to keep people too late. But payout ratio, is there a certain payout ratio where you look at it and you say to yourself, that's awfully low. That's a worrisome level.
Well, again, I would look. The first place I would start is how does that ratio compare to their 5-year average payout ratio? I would compare it to the industry. You know, in this environment, you know, maybe a low payout ratio is actually good in this environment. It does show that they can most likely meet their dividend payout. It's got plenty of room to grow if they decide to pull that trigger and really start to grow their dividend. So those are a couple of the things I would look for.
Okay, great. And I know it's getting late, so
yeah, sorry, just one other thing. I definitely want to thank everyone for joining tonight, and you know, by attending tonight's webinar, we will, as a thank you, we'll be sending out an invitation to receive a special report. It's called 5 Dividend Winners, and it's a report that looks at 5 rising dividend growth companies. Hubbell is one of those companies, and we have some looks at running these companies through analyzing using the 3 pillars of dividend investing. So as a thank you, we'll be sending out an invitation to receive that special report. So again, thanks everyone for joining tonight, and I hope you find that report helpful.
Absolutely. Thank you, Derek. We are monitoring the questions. I will pass them along to Derek. We do use these questions also to help give us ideas for future content, both webinars and articles for the journal. So we certainly appreciate everybody engaging. You see the slide with the upcoming webinars coming up next week. I will be participating in a panel for the Alliance for Investor Education. We have some great experts from outside the AAII organization joining us. Kevin Carter will be talking in 2 weeks about international investing, emerging markets, I believe China as well. And then on June 10th, Derek and our colleague, Wayne Thorpe, will be talking about the Stock Superstar Report, particularly focusing on one of the 4 strategies in that portfolio and how he uses it to find stocks. So I hope you tune in. Again, everybody, thank you so much for joining us. It was a pleasure to be your host tonight.
Thank you. Have a good night, everyone.
Thank you, Derek and Charles, and thank you for attending tonight's webinar. A replay of the presentation will be available tomorrow on AAI's YouTube channel, along with links to tonight's handouts and some of the resources discussed tonight. And this will be sent to you to your email address. Have a great evening. Thank you so much.